David, as Canadians have experienced shocks to their retirement savings, REITs have been a big component of that. And we've been hearing a lot about REITs, about commercial and retail real estate in the news recently. But tell me about your position, about Westcourt's position with respect to apartments and student housing, which you say are a big component of your portfolio.
They're a very big component of our portfolio, and certainly were long before COVID. And the reason for that is that if you take a look at real estate across the spectrum, you have residential, office, industrial, commercial. And we've always thought that the safest area to invest in real estate, especially on the income side of the balance sheet, is are in fact multifamily residential, which is apartments and student housing and things such as that, because there's a lot of factors on the other side, ex-COVID, that especially in the area of commercial and office, where you're a little bit more susceptible to changes in the economy over time. During COVID, of course, we've seen this rear its ugly head, where you can't read the paper these days without seeing a big headline about the percentage of rents that are not being collected in, for example, commercial or retail, which is fully understandable because if a store is closed, where are they supposed to get the money to pay their rent? But what has happened in this particular case, although we did not try to COVID-proof a portfolio, we feel very fortunate that in fact we are so heavily weighted on our real estate allocations to apartments and student housing, because those are two areas that we haven't seen any weakness. We've seen full collection of rents, at least in Canada, and we expect that so long as people need somewhere to live, and especially so long as in Canada they continue to receive checks from the government, which appears to be something that the federal government in Canada has agreed to do for an extended period of time, that you continue to see strength in that area.
A lot of analysts have likened this recession, this bear market, to what had happened in 08, 09. Mm-hmm. I am wondering about some of the biggest lessons that you have learned during this pandemic.
Wow. Well, it's funny because the two big lessons seem to be contradictory, but if you think about it, they're really not. The first is that all crises have certain things in common, and every crisis is different. So I know that those seem paradoxical, but if you think about them, what do they all have in common? The number one thing that all crises have in common is liquidity, 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 which is that one reason that you see stocks fall so precipitously and so quickly has to do with the fact that there's a stock market so that you can sell them right away. Even in bond land, which is also a relatively liquid market, it's about 10 times bigger than the stock market. You saw spreads widen, which is another way of saying bonds fall really quickly, because especially in an ETF portion of the world, you can just hit a big sell button and you can gain liquidity right away. What's different, however, is that this particular crisis, and you've heard this a lot, not only is it unprecedented, I've said it again, that it's also man-made, it's self-inflicted. And so that in the 2008 financial crisis, we weren't sure, if you go back to March 2009, which was really the nadir of the market of that crash, although we didn't know it at the time, we didn't know whether the economy might ever come back and what we might be able to do to fix it. Whereas here, there is no doubt permanent damage to the economy, and the part that's not permanent will take a very long time to bounce back. We get to decide when we go back to work. And so what we've found is that the same type of elements are at play with respect to liquidity, but that if one puts together a portfolio that is, as I said earlier, not necessarily pandemic proof, but is set up so that it won't suffer as much during precipitous falls in the markets, that it should be able to weather the storm irrespective of the source of the storm.
We have seen the virus easing in terms of numbers around the world. I mean, in some places, it's, that curve is flattening. Mm-hmm. In some places, we have seen a small spike in those numbers. Regions are relaxing on their social and physical distancing rules. Are we seeing a false dawn here? Are we going to hit another low, in your estimation?
I think it all depends on when and how we reopen the economy. I mean, we all know it's well tread that there are certain areas of the economy that can open much more quickly than others. I think it's going to be a long time before we're sitting 20,000 people in a sports arena or packing ourselves onto an airplane, but we might be able to have social distancing and sit outside at a restaurant over the summer where we are 6 or 10 feet apart and where we ensure that we have the proper protocols in place to ensure our safety. This is, of course, in the early innings, and it's not a straight line. So that as we watch the economy reopen and start to build back, we aren't going to see this straight line where suddenly the GDP numbers are getting better and better month after month, quarter after quarter. But that I believe that many governments, whether they be provincial or states in the US or the federal governments in Canada and the US, have very sober decisions to make regarding balancing on one side the lives of some, including people with pre-existing conditions and people that are older, against the economy at whole. And so I do believe that if this is done responsibly, that as bad as it has been and will continue to be, that there is a way to mitigate as we move forward and that the dawn will come. It just may not come as quickly as some people hope.
Oh, you had touched on not necessarily a pandemic-proof portfolio, but perhaps mitigating some of these risks as you encounter them. I'm wondering, as you take a look at that picture here in Canada, the sectors that have been really badly beaten up, i.e., energy. Do you see opportunities, or rather, where do you see opportunities?
That's a good question, and of course, one that we get asked every day from our clients. What we're not trying to do at Westcourt right now is trying to identify a certain sector that will necessarily bounce back in the short term, because we have to prepare for the fact that this could be a W recovery and not a V recovery or a U recovery, meaning that we may not yet have seen the lows. And so that what we try to do is say, why are we in certain strategies or asset classes in the first place? Why do we have those weights? And is there anything about the risk profile of an investor that has changed through this pandemic? And what I mean by that is that I've often said that the best way to measure your appetite for risk and your ability to withstand risk is to measure it while there's turbulence in the air and not before you take off. And so that we invite people to think about how they felt during March. And if all they wanted to do was get off the ride as fast as possible, over time, they might want to change their asset mix. But when we look out at opportunities right now, or potential opportunities, for example, in energy, that's one area where that story has yet to be told. We are still in the beginning chapters of understanding how Canadian energy will make its way through whether it's pipelines or trucks or rail to ports, and to refineries that are not located in Canada. That's a story that has yet to be told. We don't know what U.S. shale production is going to be like. We know that it's very capital intensive, and that capital may not be forthcoming. So there's a lot of supply and demand drivers. And we also don't know when the economy is going to reopen and when the 25% deficit of fuel use now compared to what it was pre-pandemic will ever return. And if so, to what extent? When you look at other areas, we see a lot of people saying, well, maybe now is the time to buy cruise line stocks or airline stocks. And if someone wasn't investing in that sort of thing before the pandemic, we leave that for traders rather than investors. And so what we would advocate is that people take a look at their portfolio and their portfolio mix and consider rebalancing to reflect two things. The first is, has my risk appetite changed for the next 10, 20, 30 years? And am I able to have the same portfolio moving forward from the point of view of, should I be adding to those things that have gone down in value? Because as counterintuitive as it may seem, when someone has a portfolio that's designed for a 10, 20, 30-year period, the reasonable thing to do is to rebalance by buying the thing that has gone down in value and selling the thing that has gone up. Very easy to say, very difficult to do.
David, the coronavirus has been front and center with respect to our discussions in the last couple of months. But something that perhaps we are overlooking is the election south of the border, which is months away. I'm wondering, how does this play out now with respect to investors? What should we be looking for? What happens to Trump's biggest opponent, which could be Joe Biden. How does all of that play out?
Well, one of the things that we learned back in '92 with Bill Clinton, is that it's the economy, the economy, the economy. And the economy used to be something that was measurable and where you could be objective about numbers. But of course, we live in a new world now where different people on different sides of the fence appear to be able to make up their own facts. And so that what will be important, I believe, heading into the election is how people perceive the economy is, which is not necessarily the same thing as saying how the economy is, and how they perceive all of the promises that are made during a campaign will affect them. So I'll give you a good example. In 2016, when Donald Trump went to Western Pennsylvania and told coal miners that they were all going to have their jobs back, they believed him and they voted for him. Now, that hasn't happened. During this election cycle, I think what we're going to see is we're going to see the Trump campaign going across the country telling everybody that they have the quick fix that will make the economy, not only from a general perspective, get back to where it was, but that they will have their job back and they will have training and they will have assistance. The Democrats tend to typically take a more sanguine view of things and be more objective, kind of like Hillary Clinton in 2016, telling Western Pennsylvania coal miners that they would not be getting their jobs back, which was A, true, and B, probably the wrong thing to say if you were running for president. That I think that what the Democrats are going to have to do heading into this election cycle is they are going to have to choose some of their own facts and talk about how their policies will help the most disenfranchised among the voters, some of whom voted for Trump in 2016 and now realize how tough it is for them. And they've traditionally been the Democratic voters. So that'll show itself in different areas through things like social programming. Even though the United States balance sheet has expanded more under Donald Trump than it has ever in the past, that is normally the place where Democrats live, where they talk about social policies that are not dissimilar to those we see in Canada. So I think it'll be very interesting to see the extent to which Democrats are going to get as close to being socialists as possible without ever having that word used, because liberal is already a bad word in the US. Socialist might as well be the same as communist, and no one can get elected if they're branded with that label.